Okay. So here I go. So of course, standard disclaimer, make money, be happy, lose money, don't scold me. So basic options is a contract between two parties. There's a buyer and seller. So for the option buyer, you have the rights at a certain price at a certain time to buy or sell the underlying instrument. So option is actually a derivative product. So by itself, there's no value. The value is actually derived from an underlying instrument. So of course, in this case, of course, it's stocks. It's actually stocks. So you can, number one, think about the first options. Okay, I'm actually just going to give you a theoretical perspective. Hopefully, this one can help you visualize. Later, then I'll show you the market perspective. Okay, then you see how it works. So again, if there's no questions, I'll move a bit quick. So don't be shy to ask questions. So it's between two parties. There's one buyer, one seller. So the buyer have to give the seller the option fee. And with the option fee, they have the right at a certain price, at a certain time, to buy or sell the underlying instrument. So you can think of it this way. We have a stock. Then we have this piece of contract, okay, between two parties relating to the stock. So basically, there are four very basic option strategy. Okay, call and puts. Then of course buy call, sell call, buy put, sell put. Okay. I let me just walk through this example here. Hopefully everyone can understand. So again, this is the theoretical aspect. Later from the market perspective, I will show you differently, but hopefully this theoretical aspect can help you to visualize. So assuming now we have a stock, let's say quite Orange. Now Orange is selling at $55 in the market, assuming. Okay, so of course, what we can do is we just go and buy Orange. We spend $55 and invest in Orange. Okay, so the other way to invest in this stock Orange is actually buying this thing called options. So assuming we have a seller, okay, seller willing to actually sell a call option at $5 at a strike price of $50. Time to expire in 1 month's time. So if I actually buy this call from the seller, I have to give the seller $5. And with that, I have the right to buy the underlying instrument, which is stock Orange, at the strike price of $50. Okay, hope it's clear. So basically, there's two separate instruments. So one, there's actually this stock called Orange. Okay, this stock is traded. Okay, so of course, if I want, I can just buy this stock Orange. Okay, the other way is I don't want to buy this stock Orange. I go and buy options. So basically, it's just a paper between two parties. Okay, just a piece of paper between two parties or contract between two parties, whereby there's a seller. So assuming in this case, the seller is actually willing to sell a call option at $5, strike price of 50. Okay, time to expire 1 month. Okay, and if I buy this option, I have to pay the seller $5. And within the next 1 month, I can have the right to buy the underlying instrument at $50. Okay, so as an option investor, so one thing you must be very clear about actually is this thing called the payoff table. So this chart is called a payoff table, whereby the x-axis is the price of the underlying stock. The y-axis is the profit and loss, okay, of the option buyer. Like in this case, let's say you buy option, okay, what is your profit and loss? Okay. So now in this case, let's say for example, okay, 1 month later, the price increased to $75. So what's going to happen? I have this contract. I will actually do what we call, I will exercise the contract. I will go to the seller and say, hey, hello, seller, remember I have this contract. So I have this contract. With this contract, I can buy the stock from you at $50, which is the strike price. And again, you can think about it. This is more theoretical. So I just go and pay the seller $50. I get the stock and I immediately can sell to the market at 75. So assuming that the market is actually at $75. Okay, this contract, I run to a seller and say, hey, seller, remember this contract, I give you $50. Then you give me the stock that I can go and sell to the market at $75. Okay. And if let's say 1 month later, the stock price go to $30, I will just let the contract lapse. Okay, because it doesn't make sense for me to go to a seller and say, I buy from you at 50, given that the market is selling at 30 right now. Okay, so basically I've actually explained a call option and explained from the perspective of a buy call. And of course, what exactly is a payoff table? Linda, don't mind do me this favor. After my explanation, do you have a rough idea what option is? Maybe just help me type yes or no. Okay, and the rest, any question, please ask. Linda, yeah, don't mind if you can, because you type 0. Okay, don't be shy. If let's say after I talk so much, you don't want talking about, please just type no. Maybe you are doing somebody else a favor. Okay, good. Thank you so much. Anybody, any questions at this juncture? Okay, all good. All good. Okay, great. Now then I go a little bit faster. Okay, then of course there's actually this thing called the put option. So the difference in put and call is this: put give you the right to sell. Sell the underlying instrument at the strike price. So just now the call option gives you the right to buy. Put option gives you a sell. So you actually buy a put if you are in the opinion that the price is going to drop. Okay, so thank you, SM, for the question. So it's all to exchange. So what I'm actually telling you now is very theoretical. Hopefully it can help you to visualize. Later I'll show you the market perspective. Okay, so it's all through stock exchange. Okay, so put give you the right to sell. So like for example, in this case, after I buy a put, I give the option seller $5. And if let's say the price becomes $75, okay, now in this case, it's sell to the option seller, not buy. So it doesn't make sense for me to buy at 75 and sell to the option seller at 50. Correct? It doesn't make sense, right? It doesn't make sense. But if let's say the price dropped to $30, okay, what I'll do is this: I will actually buy from the market at $30 and run to the option seller, say that, hey, brother, we have this contract, I can sell to you at 50. Okay, so in this case, I actually make $20. Okay, so again, Linda, don't mind do me this favor. Do you understand what put option is? And of course, the rest, okay, thank you so much. The rest, if let's say a question, please ask. Please ask. Okay, so that's why finance is actually a very creative industry. Also, we can actually create billion-dollar market out of nothing. So basically, it's just a contract. By itself, there's no value. The value is actually derived from the underlying instrument. Okay, that's why it's actually called derivative. So option is a derivative instrument. Okay. Okay, put. Okay. So okay, so put give you the right to sell. Okay, so SY Lee, call option, okay, clear. So SY Lee, are you clear about the call option? Don't mind you just let me type yes or no. Yes, okay. So put give you the right to sell. Okay, again, this one I just have to picture visually. So let's say, for example, you buy a put option from the option seller, you pay him $5. After that, you have the right to sell him the underlying stock at $50. Okay, you do this with the opinion that you think that the price is actually going to drop. So let's say, for example, the price dropped to $30. Then what's going to happen? You can actually go and buy from the market at $30 and go to the option seller and say, hey, hello, brother, I got this contract with you. I have the right to sell to you at $50. So you buy 30 and you actually sell to him at $50, you make $20. Okay. But if let's say the price didn't go away, the price go up to $75, then what's going to happen? It doesn't make sense for you to go to the market and buy at 75 and go to the option seller and buy at buy at 75 and go to the option seller and sell to him at 50. It doesn't make sense for you to do so. So what do? You actually let the option contract lapse. That's it. You just actually lose at $5, you let the option contract lapse. Okay, SY, did I answer a question or you got any? Okay, good. Okay, great. Thank you so much. So please don't be shy. Keep your questions coming. Like I said, this session is more to answer your questions. If you don't have questions, then this session ends very fast. Okay, so come back quickly. Okay, so so I've actually explained call, explained put. Anybody has any questions? Okay, Brian, hold on for a while. I actually, of course, all this is actually done through stock exchange. Okay, all this is actually done through stock exchange. Later, I'll show you the market view. So you can think of it this way, that is like a third party whereby, or we call them market maker. So they will actually link you up with the buyer and seller. Okay, so I'll show you the market view later. Okay, any questions, anybody? Don't have, good. Okay, so for options, anybody can also be the seller. Okay, anybody can also be the seller. So like for example, you don't have to be like institution, you don't have to be someone very rich. No, everyone can be seller. Okay, so basically, of course, seller, what happened here is this: as a seller, you collect the premium, but you take the risk. Okay, so like for example, you sell call. So what happened here is this: it's just opposite. If you buy call, you will make money when the price go up. Okay, if you sell call, you will lose money when the price go up. Okay, whatever that the call buyer make is the call seller loss. Okay, and of course, if let's say you buy call, if the contract lapse, okay, the person pay you, the buyer give you $5. As a seller, you keep the $5. So in options, you can be a call, you can be a seller as well. You can of course sell calls. You can of course sell puts. Okay, which is just the opposite. So you look at payoff are just opposite. So for puts, right, when the price go up, as a seller, you make money, because the contract lapse, you collect the $5. Then if let's say the price go down, okay, you may lose money. Why? Because they will exercise. You have to buy at a higher price. Okay, so it go down. Okay, questions? Anybody? So what I just want to reiterate is, for put option, you can be a seller also. So these are the 4 basic strategy: buy call, buy put, sell call, sell puts. Any questions at this juncture, anybody? So I just want to show you how is it like on my trading screen. So this is Google. Okay, maybe I just type some of the popular ones. So let's say Tesla. Okay, good. So Tesla, of course, now the market is not open. So assuming it's open, Tesla, the stock price is $221. Can you see $221? So of course, I could buy Tesla, or either that, in this case, I could actually just buy the option. I click on options. Okay, so I can actually choose the expiry, as you can see. So there are different expiry. So usually I choose one is actually about 1 month, which is 30 days. So this option will expire in 30 days. Okay. Then what I do is this, I will usually try to make $1. Okay. So maybe I talk about buy call first. Okay, so I can actually choose here. So let's say, for example, I can click here, buy call. Okay, can you see this one? I can buy call. So assuming I want a strike price of current one, similar, let's say 220, for example. 220, so you can see the option price, okay, sorry, the option price is about $13.65. Can you all see? So assuming I buy, okay. So assuming I do this, so basically my strike price is $220. Expiry is actually 1 month later, 30 days. And the option premium is $13.65. So of course, if I do that, assuming that by the end of 1 month, assuming that the stock price go up to, like, for example, 300, 300. Okay, then I could actually go to the option seller and say, hey, hello, brother, I can actually buy from you at 220. And after that, sell to the market at 300. So of course, all this eventually you don't have to do anything. So basically, you can just trade, can just sell off in the market. But again, I help you to visualize. So okay, I talked about visualized possession. So assuming I buy this, let's say 1 month later, it go up to 300, for example. So what happened here is this, I basically make $80, okay, because I have the right to buy at 220 from the option seller, then I can sell to the market at 300, so I make $80. Okay, so of course, all this is on a platform. So what happened here is this. Of course, if let's say, for example, the market price go up, right, the option price will also go up. Okay, so basically what's going to happen is, let's say, now is September 20, and assuming that the Tesla now is $300, this price will probably equal to 90 over dollars. So what I'll do is I'll just sell the option. Then I will actually make my gain. Okay, so basically when I trade options, I don't have to do the stock stuff. So I don't have to like, oh, okay, I take the stock, then go and sell the stock market. No need. Okay, so what's going to happen here is this. On this day, okay, I could actually sell my option away, okay, and the option will actually, okay, assuming the price is 300, the option price will actually go up to become $93. Okay, which is the difference between 300 and 220. Okay, so again, what I want to say here is this. Once I do with option, I don't do with stocks. Okay, so just now what I explained is theoretical. So down here, I just buy option, sell option. Or either that, buy option, let the option expire. I don't have to like, take the stock and go and sell the stock in the stock market. Or after that, go and buy the stock or sell to the option. Sell to the option buyer or seller.